In today's video, I'd like to take a look back at what was the best buying opportunity in the past 3 years, the lows in February of 2016. I'd like to show you how my technical studies, as well as my evaluation of the sentiment, provide clients with valuable advice. This is time to buy both stocks and ETFs. Let's take a look at the analysis. For those of you who don't remember early 2016, the market declined sharply into the middle of the month, prompting headlines like this, that a recession worse than 2008 was likely. The market bottomed about on that day and started an oversold bounce, which we were anticipating. What happened after that bounce would be pivotal in analyzing whether we're going to see another market decline or a sustainable bottom. By February 13th, when I wrote this article for Forbes.com, I quoted the idea of Baron Rothschild that there was so much carnage in the markets that coincided with good technical signals suggesting it was a good buying opportunity. Let's look at some of that evidence. This is a chart of the New York Composite, one of the many major market averages I follow. You can see the low I was speaking of January, the rally, then the subsequent decline, though the advanced decline line held up quite well. So I was watching this downtrend for signs of a turn. A turn became very likely as of February 12th, when this chart was put together, as the McClellan oscillator shows a very strong bullish divergence, this line E, which was consistent with the market low. Also, I follow the new high, new low data from the NYSE. You can see back in the period from August through September, the new lows peaked when the market dropped on August 24th. Then as the market made a new low, very few stocks made new lows with that. That was a bullish sign suggesting that the market was sold out. It was confirmed by a pattern of higher highs in the number of stocks making new highs. Even stronger evidence emerged in February as the new lows hit over 1,200 on January 15th, but when the market made a new closing low in February, there were very few new lows. This was confirmed by the action of the number of stocks making new highs, which formed higher lows, a bullish sign that the market was getting healthier internally. As the rally progressed in February, the NYSE line moved above its moving average, and then at the start of March 4th to be precise, moved above its downtrend. That was a sign that the worst of the selling was over. All that was left was for the AD line to make a new high, which happened in early April. For clients of the Viper ETF and Hot Stocks Report, I frequently quote and analyze the sentiment data. It was very pertinent that at the mid-January low, only 17.9% of the from the AAI survey were bullish. This was the lowest level since 2005, and when the market made new closing lows in February, only 19.2% were bullish. That was a very strong sign that all the selling had been done. You should note that at the March 9th low in 2009, the current bull market's low, bullish percent was at 18.9, similar to what it was in January and February of 2016. In another Forbes article on February 23rd, I happened to note that the fast money traders were very bearish in the stocks, wanting to sell a rally, and they were not convinced the market had bottomed. This was, of course, contrary to my analysis of the advanced decline line and other technical indicators. So I advise clients to look to buy a dip, not sell a rally. Well, I hope you found that analysis informative. I've been doing this for a number of decades, and I'm always excited by the markets. I think my unique combination of the advanced decline analysis and my reading of sentiment can spot buying opportunities that most miss. The same advice is provided to both ETF and Viper Hot Stocks clients twice a week in my publication. In addition, Viper ETF clients get a special weekend review of the ETFs I follow, while Viper Hot Stocks subscribers get a list of the new weekly buy and sell signals in the S&P 500. I hope you'll decide to subscribe. Thank you.